this is a profound statement. Most people are either way underinvested or way overinvested. Very few people come in and I think have the right mix, because
Exactly.
people feel like, well, I've got $200,000 that I've saved in my savings account, and I want to buy a home in 3 years. Like, what should I do with this? It's like, you probably shouldn't do anything.
Right.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And John.
Morning.
And got a quick question, kind of topic we want to start with, and then we're going to jump through, kind of plow through 4, 5, 6 charts. Just kind of highlight some things. You know, a lot going on. So we're going to hopefully have some good conversation there. So if I always say this at the end of the show, but I want to throw it out there at the beginning today. If you haven't liked or subscribed, please do so. If you have any questions or comments, please leave a comment, shoot us an email. We love seeing those and getting those. It helps with content that we're trying to put out, and being able to answer questions. So give us a like, subscribe, and shoot us a note. All right, on that note. So quick question, how do you balance short-term goals, like buying a house, just as an example, with long-term goals like trying to save for retirement? So how do you, this is something that we deal with on a very, just a day-to-day, weekly basis.
We do, yep.
On, how do we do both? How do we do everything we need to be doing for retirement, but also, live life and achieve the short-term goals? So as you think about that question, and as you're guiding people through their financial plans, what are things that come to mind, and how do you find the right balance there?
It depends on kind of what those short-term goals are, where they're at in their stage of investing. I mean, you think about saving for a house, typically younger, possibly younger. You think of other short-term goals, wedding expenses. I'm thinking of larger ticket, college. That's a big one. College education for kids. And so it's a struggle. I mean, it's something where, we're taught for retirement, save, put as much money in your 401k. I mean, John, I've heard you talk in your office, and I think we all use the term buckets, that there's, you need to have buckets of money, going from the most liquid to the most illiquid. Most liquid would be checking, savings. Most illiquid 401k type retirement plans. And I think there is a balance to where, and again, I keep going back to kind of where they're at in their life, in their career. I don't know. I'm when you hit me with that, I was thinking, oh shoot, he's coming to me first.
I could tell you, Lee, and I know where you're going on this, but I think so. If somebody comes into our office and says, "Hey, we're going to buy a house in 2 years, and I want to put X amount of money away. I've got it already saved for that, and I want to put this much money away a month for that purpose," right? I do think it's really important to understand risk and reward in that short-term kind of thing. Like the risk of putting it in this, like, for example, this market is crazy, and you're going to have some charts to talk about how crazy this market is. By the way, we're only down 6% year-to-date, 6.8% as of yesterday, which is really not that big a deal.
Yeah.
I know we made a big deal about it. But anyway, if somebody says they want to put money away for something within 2 years, I do not, now me personally, I do not want them taking market risk typically or a lot of market risk with that money. So example, let's say I want to put $100,000 on a house. I've got $70,000 built up in an account, and I'm going to add $1,000 a month to that, whatever, trying to get it to $100,000 by the time I want to get the house. The worst thing that I think you can do with that is put that $70,000 100% into market, have the risk of the market corrects, goes down 20%. You're putting money in. Okay, that's fine. But now it comes time for the house, and you've got $50,000.
Sure.
And you had already built it to 70. If you know that goal is right around the corner, and I'm using 2 years. I mean, it could be 1 year, it could be whatever.
Well, but I think that's important because what is that time? The time,
yeah.
Is it 2? Is it 1? Is it 5?
Yeah, going back to college planning. So as a great look at time, if your child is 1, 2, 3, and you're planning for college education, you've got time on your hands. And usually, typically, 529 plans, whatever, will diversify a portfolio based on the child getting closer and closer to college, gets less aggressive as they get closer to college. That's typically how it works. Similar story on these other outlier things. If you've got the less time you have, probably the more conservative you probably should be, especially if you've built enough assets up. Now, if you're rolling the dice and you need to get $100,000 in 2 years and you've only got $10,000 started and you're not going to put any money into it, you might want to get aggressive, right? I mean, that'd be one example where you're way behind the goal and it may not happen, so you might have to be a little bit more aggressive in the market. Does that make sense? But typically when you're planning things out, shorter term things that you know you're going to have, I like to peel that money aside, put it in different buckets, put it in more conservative buckets.
Yeah. I mean, I always tell people
what you need.
If you think or know that you'll need money in 3 years or less, it shouldn't be invested in the market.
Yeah.
Okay.
Like I go out to 3 years because you look at, I don't have charts ready for this, but like you look at all kinds of data, like rolling 3-year periods. It's like the market can go up or down or sideways.
Oh, yeah.
Like in a 3-year period, like that's a drop in the bucket
Yeah.
in terms of time from a market perspective. And so that's how I always do it. In terms of prioritizing short-term goals versus long-term goals, it goes back to you have to prioritize, what is most important, because somebody who, their goal is I want to retire at 50. Well, you need to know if that's your number one goal or if that is just a goal, because
Sure.
you may not buy the big dream home at 35 if your number one goal is to retire at 50, right? And so you have to know not only what your goals are, but prioritizing those goals and ranking them in terms of what is the highest non-negotiable goal that we are so fixed on this, and we're so adamant that we want this to happen. And for some people, it'd be like, I'd much rather work 5 years longer in the future if we can get in our dream home today.
Yep.
And so you just have to know what's most important. You don't, my personal opinion is it's trying to find the right balance of you want to be planning for the future, obviously. It's what we help people do, and how we make our living. So that's important. But, you want to be planning for the future, but we're also not guaranteed, Scripture tells us we're not guaranteed tomorrow, much less 20 years from now. So, are we really going to sacrifice everything today for the hope of what some future may or may not look like that we have, if we're being honest with ourselves, very little control over to begin with?
Yep.
So my personal opinion, prioritize, know what's most important. Don't sacrifice everything today for the sake of tomorrow, but also don't sacrifice the future. Like steward your resources well so that you're set up for the future, and don't only live for the moment. Somewhere in the middle is the right solution, I think, for most people.
I've had this happen twice, or two different things happen a lot of times. I have clients that when they're 75 years old, they have more money than they're ever going to spend. They don't know how to spend. They're going to leave a bunch of money behind in legacy, even if they don't want to, because their entire life they have focused on building and saving and being really frugal and not doing anything. And okay, that's fine. I have other clients on the other side of that fence that have spent everything. They have traveled the world. They've doted on their kids. And this is more, I'm talking about my wife, Kathy. And they've done everything, spent the money. And at 75, they have nothing, right? And I say this because both can be happy, okay? And I know this sounds crazy, but to your point, I love what you said there. Prioritize what is important to you. And we're not guaranteed tomorrow. And I'm not saying you should run out of money at 75. That's not my suggestion. But know what's important to you, because oftentimes folks that do everything right get to that point where they're retired and have all the money in the world. They don't know how to spend. They don't want to spend. They're not used to spending. And it ends up going to somebody else. And they didn't have some of the opportunities they could have done in their lifetime. They passed on because they were so focused on the one goal, and then they don't know how to spend it. Mm-hmm. I know that sounds kind of silly, but that's happened and many times. The other thing I think on, which I love the points you've been making, I had a client in the other day, yesterday, first appointment. They have not ever met with an advisor. They have money in about 10 different places. They have no idea how they got it there. Okay. They did their 401ks, they did their matching, but they've built their portfolio up to where they can retire at an age they want to, and have done no planning. But one thing they did, which I thought was important for everybody to know, and young people especially, if you're investing long-term, you think like the 401k plans, just make sure you're always investing enough to get the company match. Those little simple things. Mm-hmm. Even if your priorities are shorter term and you want the house or you want whatever, make sure you're doing all the buckets. But most importantly, make sure you get free money. Don't leave that on the table because of a short-term goal that you prioritize over the long-term goal of retirement.
Sure.
Right? Always maximize, be efficient as you can. And, of course, we can help people find out what that is. But folks yesterday didn't know what they're doing, but they did everything right because they maximized all their efficiencies, even if they didn't know it.
Yeah.
But they did. And it was great.
Lee, any other?
One question I was going to have is we were talking, with the examples of, people have cash, what do I do? What do you do with the client who is fully invested, doing all the right things, maxing 401ks out, so forth, and now they have a short-term goal?
And it's all tied up.
Yeah. So the examples we've been talking about are the people that have cash available and they're choosing short-term versus long-term, and we've all said, keep it fairly liquid. What do you do with the client that is fully invested and is currently investing, and now they have a short-term goal?
Oh, we have that happen all the time. And when you have somebody who wants to retire at 55 and all of their money is in 401ks, it's a tough choice, right? Is that what you're talking about?
Or forget retiring.
Just need money for a house or whatever.
Or a wedding, or yes.
So, and again, if we get to talk to clients, right, when we're building a plan, especially younger, I always think there's 3 buckets that you should always contribute to. And an emergency bucket where you have money there in case something bad happens, car breaks down, furnace breaks down, whatever. Okay, I think can be smaller-ish, but you need the emergency bucket. I love the retirement bucket, Roth and traditional 401k, whatever, just money that you're putting away for long term. But I also think there's an argument, and a big argument in today's, a lot of young people want to retire before 59 and a half. I hear that all the time. To do that properly, right, you need a non-qualified bucket, which is just money in, it doesn't necessarily have to be safe. It doesn't have to be in the bank in a CD or a money market or whatever. It can be invested in the market, but that non-qualified bucket is something I think we often find clients didn't do. And if they need an emergency or a wedding or something down the line, that's where you would draw it from, right? If you have multiple buckets and one of them is a non-qualified investment account, that to me is smart investing. And you start that when you're young. You start putting money away in a non-qualified. So if you're not doing that, you get to the point where you're 55 and all your money's wrapped up. You just have to find an alternative, and I'm not to get into the weeds here, but you can find ways to borrow money from your 401k or whatever. But if you don't want to do that, proper planning would say have multiple buckets.
Yeah. I think prioritizing goals, knowing that there's always going to be the exception. Like, you can only plan for what you know, and then there's always going to be the unknown. So just accepting that.
Sure.
I think most people, this is a profound statement. Most people are either way underinvested or way overinvested. Very few people come in and I think have the right mix, because people feel like, well, I've got $200,000 that I've saved in my savings account, and I want to buy a home in 3 years. Like, what should I do with this? It's like, you probably shouldn't do anything,
right?
Because if you do and something changes, like, it starts messing up the rest of the plan. But like, having that money liquid and safe and ready for what you're trying to accomplish is going to help keep the rest of the plan in place and intact. And so, prioritizing goals, bucketing money, not investing for some unknown date that is not guaranteed, and being so fixated on that you're not enjoying the resources that God's blessed you with today.
Exactly.
And then not spending everything today and wasting and not being a good steward for the future.
Sure.
Finding that balance is easier said than done, but that's what we try to help people do.
Yes.
And if it were that easy, I'm not sure how many people would come see us.
Oh, right.
Yeah.
So.
Exactly true.
So I've got 4, maybe 5 charts here I want to throw up. So this first one I think is interesting, especially with everything going on right now. So it's, what if you invested at the start of every crisis? We've got to get this TV set up so I can throw this up in front of you guys. But so if you invested at the start of every crisis, so this covers Great Depression, World War II, oil crisis in 1973, peak inflation 1980, Black Monday, dot-com bubble, financial crisis, pandemic, blah, 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 blah.
Yeah.
So it shows max drawdown for that crisis, and then the annualized S&P 500 return since the beginning of that crisis. So this is like, if you said, hey, I invested at the worst possible time, right before something terrible happened and the market pulled back, how have I done since then? every one of them is positive.
Yeah.
Obviously, even just going back to the pandemic, which isn't that long, all that
Yeah.
long ago. The average annualized return is 7.9%, even if you invested at the worst moments, right? With the average drawdown of 49.4.
Yep.
Primarily heavily weighted with the Great Depression being kind
So
of
think
the
about
most
that. You
extreme
put
outlier there.
$100,000 in, it goes down to $49,900 if it's all invested in the market, but you average 7.9% above.
Well, like if you invested,
which is great.
2020, this is 6 years ago.
Yeah.
If you invested, this is March of 26.
Yeah.
So this was literally like 6 years
Yeah.
ago when this all started. The S&P was down 33.9%, right? So you were immediately had 70 cents on the dollar.
Yeah.
But if you've held on and stuck with it, you would have annualized 11.7% a year, if looking back over the last 6 years, right? So I think this is just a good reminder because you have clients out there who maybe they did just invest some new money, or they had some cash and they put some money into the market, or and it can be easy to think like, oh shoot, the last month or two I'm down 4, 5, 6%, 10%, however you're invested. Should I get out now? And it's like. I like this chart just because it's a good reminder. Hey, even if your timing wasn't necessarily ideal, like historically speaking, the market says like you're going to be fine. Stick with it. This goes back to though, if you're going to need the money in the shorter term, that money probably should have never been invested in the first place.
Exactly.
So like that money, if you're putting money into the market, it needs to be long-term money. If it is,
then you need to be okay with
interrupt the plan.
Well, and it goes back to know your risk tolerance, right? This is a great example. If you went in and you went down 33% because COVID, you put it in right at the top and went down 33%, that really stinks. And you emotionally, it could just kill you.
But because your chart was at the beginning.
Yeah.
At the beginning.
This
of
was like
crisis.
right.
You started it at the beginning. Yeah.
Correct.
It's interesting that we're having this conversation today because today is the 6-year anniversary of the low of the pandemic.
Wow.
On March 25th, we began
the climb back. It was a
one of
very
the greatest
quick,
bull markets.
33% down, and then a good recovery.
It was a month. It happened in a month. Yeah.
Do you know? If this is a dumb analogy, but we all have people in our family or somebody we know that's like this. And in my family, it's me. Whenever like I'm watching a Razorback basketball game or football game or something, and they get down 10 points in the first half, and I might, it's over. We have no chance. It's over. I'm done. I'm not watching this anymore. But of course they have a chance, right? But emotion gets to us where emotionally, if things start going against us, it's easy to get deflated, make bad decisions because you think it's just not going to work out. 2008 financial crisis, the market went down, and I always say this, but and this is where I'm going to lose Matt. The Dow was at 6,400 on March 7, 2009. It got to 50,000 here recently before the Iran war. I mean, think about that, 6,400 to 50,000. There are people I know that got out around that 6,400 mark. It might have been 7,000, 8,000, whatever, and never went back in and missed. And so emotion killed their chances. This chart is exactly explained.
It goes back to bucketing the money. If you know what bucket should be long-term investment and what money should be in that bucket, then you need to stick with it. So here's the next chart. Win ratio by different stock bond splits. So this shows allocation of 100% stocks all the way to 100% bonds. And then, it goes 100% bond, 100% stocks, then 90% stocks. So 90-10, 80-20, 70-30. And I really need to show this to you guys on the TV so I don't have to explain every chart. But it shows you the win ratio. So the rolling win ratio, in terms of positive years, the highest win ratio is actually a 20% stock, 80% fixed income.
Interesting.
The two of the lowest are actually the 100% either or. So 100% fixed income, 100% stocks. Now this has nothing to do with return, right?
Right.
This is just win ratio, so positive return ratio. Your most consistent highest is the 20/80, the 30/70, the 10/90 is pretty good. So actually a very low allocation to stocks because of the volatility that equity markets can provide. Sure. And then fixed income. So this just going back to your point, John's doing a webinar tomorrow on asset allocation, risk management. So this would be a good chart kind of to cover on, depending on your risk tolerance and how comfortable you are having negative years and a number of negative years would dictate, how much fixed income or equity allocations you need to have. So a good reminder with everything going on right now, make sure you understand your risk tolerance and what that looks like. Okay, this is out of left field, something completely different, but again, just kind of timely with, oil prices, inflation concerns, unemployment, kind of the labor market. So this is continuing the unemployment claims. I think it's just a good chart because it goes back to 1970, and we often can get fixated on the headlines.
Yeah.
Because a percent increase in
sure.
unemployment, or whatever, it's like, well, what base is that coming off of?
Right.
Are we coming off all-time highs or coming off
Right.
all-time lows? Because a 10% change can mean two very different things.
Sure.
Yeah.
This zooms out, looks at continuing unemployment claims over the long term. It makes it look like in COVID, I don't know how the world didn't end, but
Right. I see that.
I guess it almost kind of did. But it just shows you that, like, hey, we're at a very kind of historically low to norm.
Sure.
Nothing crazy
Right.
yet. It has been trending kind of higher, but that's coming off of, a low base a few years back. So I just thought an interesting chart, kind of putting things in perspective over a longer period of time.
I like that chart because everybody's mad or nervous about AI taking over the job world, and AI has been around here for a while, and that makes us look normal.
And then,
It's
so
fine.
that was the unemployment.
Yeah,
That
like
was
that.
the continuing unemployment claims. This next chart is just the unemployment rate, 4.4%, right? So it's
Yep.
a little higher than it was a few years ago. But if you zoom out, go back to 1970, very much a kind of a normal range. So, any thoughts or takeaways there that you guys want to touch on?
All I have to say is Jerome Powell came out last week and had his Fed minutes, and you can listen to it all, blah, blah, blah. Not anything surprising, but one of the stuff that we talked about in that, or they talked about, was maybe some inflation concerns from the oil, from the war. And yeah, I knew they would talk about that, but again, most people think that's going to work itself out. I don't know if you guys saw oil prices yesterday were down. Today they're slightly up. So they were down basically $10 a barrel yesterday. Today they're up, well, at least last I looked, $3 a barrel. And that helps, that correlates with the market, which way it's going up or down.
Sure.
But anyway, I was thinking about the unemployment numbers, and to your point, we overemphasize when it goes up or down from the last report.
Correct.
Not looking at the long term, we're okay. Like, it's not out of whack at all. Now, it could trend that way. Like you said, if you see a trend, I mean, you got to pay attention. And then it obviously can creep up on you and get concerning. But I don't find it concerning at all, even if we talk about it.
It's the same thing like an investment. Like, a 5 or 10% pullback from all-time highs
Right.
is very different than a 5 or 10% decline when you're in the, an additional decline when you're in the
Right.
middle of a decline, right? Because you'll get these
Exactly.
like short-term rallies in the middle of like a bear market or something, and having a 5 or 10% pullback when you've already felt 20% is very different than, hey, we hit all-time highs and we had a little 5 or 10% correction. And so the same with like an unemployment. If unemployment, they give you these like rate of change, and it's just like, well, what is that from? If that's from all-time high employment,
Right.
all-time low unemployment,
Yeah.
then it probably isn't too meaningful.
I'm not
Right.
going to get. I'm not going to pull a John and get political on this, but this is
Too late.
So
You
this
just
is
did.
not. This is not going to be a political statement. There's a lot of noise out there about the average price of a gallon of gasoline right now is what, $3.90 ish.
I don't
Yeah.
know. I saw on CNN they're like tracking it.
Okay,
daily.
so
In
it's-
Arkansas, it's
Yeah, we're
Pretty
we're,
low.
We're lower,
Yeah.
but I mean,
Yeah, yeah, yeah.
nationwide,
Yeah.
let's call it $3.90.
yeah.
3 years ago, 3 years ago, 2, 3, 4 years ago, it was in the mid to upper fives. And so,
Dang.
like you said, if you pull back and look at, yes, is gas up from a month ago? Obviously so. Is it up from 2 weeks ago? Yes. From last week? Yes. But 2, 3, 4 years ago, I mean, we're still almost half of where we were. So perspective is everything. I just found it was very interesting, the noise, in Congress.
Yeah.
in Washington.
Well, the noise has gotten louder. Like in our careers, politics has always been a part of this, but not as much as it is now.
Yeah.
And if you're on one side or the other, every little bit of news that favors or disfavors the other side is just exasperated.
Sure.
You know, and talked about longer or more than it should. We have to like keep this non-political and stay calm in the midst of some of this rhetoric, or you know the stuff that you hear on
March
news.
20th. So that'd have been on Friday.
Yeah.
The average, according to AAA, 391 was the average.
Yeah, CNN has it. I saw this the other day. They keep on today's gas price like a tracker. This was This was the change since February 28th. The average price is $3.98. It's up $1.
Yeah. And again, I'm not.
Yeah, but the price of oil has basically doubled.
Sure.
I mean, in that time because of this war,
it is felt, and I'm not going to downplay that. I mean,
yeah.
What also came. Sorry, I'm going on a little tangent here, but I also saw what came to. What I realized was the difference in. You know, I obviously knew like California, and certain states have like really high gas.
Yeah.
You know, it's like, well, why is their gas so much higher? You start looking at the gas tax in some of these states.
Sure.
It's crazy.
Like California is almost 71 cents per gallon. Illinois 66.4. Pennsylvania, Washington, Maryland are all very
What's
high.
Arkansas?
Arkansas, I want to say, let me see if
We're on the lower end.
Sure. Well, we have some of the cheapest gas in the country right now.
Yeah, we do. And I was in Florida and rented a car,
it's
and
like
it was pretty
24.7,
expensive.
25.
So a third.
Yeah.
Yeah.
Makes a difference.
Yeah, it does.
Well, especially when gas goes up, right?
Sure.
Then you really start feeling it or noticing it.
Well, to your point, it's perspective. You know, it's perspective.
What's funny is the flow of oil has not really been disrupted as much as we are being led to believe because we have opened up reserves. We've got stuff going. And the Strait of Hormuz really affects China negatively. And I think that's the stuff that it doesn't really, but it obviously anything affects
oil's price, you know,
it affects all
globally,
of us. Yeah, it does.
you know.
Well, if it affects China, it affects us in even if it's indirectly. But I always laugh at whenever you do see oil prices go up immediately. It's like little robots are on all these gas places that are, it's raising the prices. Yesterday when it was down $10 a barrel, I didn't see those same robots lowering it down.
Hey, trust me, that doesn't go unnoticed.
No, exactly.
Yeah. Well, I hope you guys enjoyed the conversation. Any parting thoughts or words?
No.
Proper planning equals
Be sure to check
success.
out John's webinar tomorrow.
Hey, and in next week's podcast, I'll put a plug in for it. We have a special guest, John. You'll join me for that one. Matt will be out of town, but we have this will be her third time to be on our podcast.
Aliaga.
Stephanie Aliaga from JP Morgan will be our guest. Nice. She'll follow up a little bit on her. She has become known in the industry as an AI expert.
And she's everywhere. She's on news and
she's to get her on our podcast. We're very fortunate.
That's cool.
So we'll touch on AI, kind of get some updates there, and then we'll ask her some of the more pertinent questions about what's going on in today's economy. But that'll be next week on our podcast.
And I promise I will listen a lot more than I talk on that one.
Everyone appreciates that.
Yeah, I think so.
As always, we appreciate you guys watching and listening. Give us a like, subscribe, shoot us a comment or an email. We appreciate it, and we'll see you guys next week.
Have a great week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.